How long should you be holding onto your property investment before it reverts back to the average growth rate? I'm Jared Krause, co-host of the Property Pals Australia podcast.
Yes, and I'm the other co-host, Sam, and in this episode we chat to the wonderful Luke Metcalf, who is at the top of Australia's property data world with over 3 decades of experience as a data scientist himself. We discussed some really interesting things. It's a little bit more data heavy, but really important for you and your investing success, I believe. So one key thing we talk about is the property laws that are based on the natural laws of life and investing that show up in his property data.
Yeah, we also discuss population trends and the opportunity for property investors based on population trends and what's going to be happening in the future. We also discuss investing in metro areas versus regional areas and how they perform differently. Now, this is part 1 of this episode because it's a beast of a chat with Luke where we talk about so many things. But before we get stuck into this pod, make sure you go away and get our How to Maximize Your Borrowing Capacity mini course. You can get that at propertypals.au/resources. It can help you get a higher borrowing capacity to acquire a better asset for your investment portfolio. Let's dive into the pod of part 1. Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jared, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional.
I've been tracking Luke for a while now. He's a data scientist with, I don't know how many decades of experience you've got, but you've entered into some really interesting property data with microburbs, and I feel like you've got probably the largest data metrics I've ever seen in the industry. And what you've built out with microburbs has been something that buyers agents use, personal investors use. So I thought it'd be really good to get you on the Property Pals Australia podcast and I guess share with everyone your wisdom. So how did you, starting off, can you tell us a little bit about your journey and how you actually come to even starting microburbs?
Yes, and yes, thank you very much for having me. And yes, it is multiple decades. It's at the point where you don't want to talk about the stuff that you were doing 20, 30 years ago, just because it makes you look old. So I'd like to think that mine's still very active doing stuff. But yes, I've been working with data for like 30 years and built and sold data businesses in the 2000s. But yeah, microburbs, that story, I guess that's really what people want to focus on. So we started that in 2014. So I had this great background as a end-to-end entrepreneur, from creating a business to sale, and really got stuck on this Australian real estate problem because it's something that everyone's talking about. There's all kinds of ideas floating around at dinner parties and on the media. And very often as a data scientist, I have this urge to be like, well, I can prove or disprove that. So I can actually answer this. This is not just merely an opinion. And you've got all these conflicting opinions. So it's fascinating for me that's what really drives me, is learning new stuff that nobody knows. So uncovering new information given large amounts of data. So yes, you mentioned very voluminous data, billions of data points across all kinds of stuff. How do you get to billions? That's because it's very multivariate. So it's a whole lot of condition of this and that and this and that, and it covers tax and finance and welfare and demographics, amenity, and of course, most importantly, real estate listings. And we have 90 million of them, and we go back to 1990. So a really big thing for me, and this will, I think you'll see this come up over and over again in the conversation. My approach is much more about what are the laws of real estate, not so much what's trendy right now, because trends can go into reverse quite easily. You see that all the time. You see, regional Australia takes off, and then it goes back relative to the capital cities, and you see that for all kinds of things. So for me, the big thing is what can you rely on long term? So what seem to be the things that are like the fundamental dynamics of the real estate market? I'm less about this kind of dwelling is taking off right now. Jump in now before it's too late, because that, I don't know, for me as a data scientist building these models, if it's something new that there isn't a lot of information going back a long way, then it's hard to know, look back through time, exactly when to get on and when to get off. Maybe like if you know people like in council, or there's all kinds of gray area things that you can do where you probably can do that. But for me, as trying to be as scientific as possible, going over a very long period. So that's why we go from 1990 through to today.
Yeah. That's probably one of the gripes I've got with the data. That's obviously come through more so now with the, I guess, advancement in technology. There's a few data houses out there, and like property is always been seen as a long-term game, right? But people looking at short-term growth metrics like vacancy rates, owner occupiers, and then obviously the trends in, I guess, short-term data. But like for me as an investor and then advising people on where to put hundreds of thousands, if not millions of dollars into a certain location, it's like, well, sure, the short-term data is good, but once again, you don't want to see 2 years of growth and then it stagnate for the next 6 or 8 years. So like what you just said really resonated with me. So like how are there sort of key metrics that you look at to build that fundamental base, or is it just a combination of like a large data source that's giving you the confidence? And how have you really, I guess, come to the confidence level that you've built out with microburbs?
Yeah. So to answer that first point there about what time frame should you look at? So we look at many time frames. So you can never know for certain. So there's no time frame where you can know absolutely this is going to be the time to sell for this. So you can reduce your risk by taking a medium and short-term view. Over the very long term, it's harder because obviously there's less data to learn from. So for me, if I was buying an investment property, it'd be very much about, I want it to be the right price right now. I want it to be underpriced, but I also want it to have good, solid potential for longer term growth, so that you've got options. Maybe it comes down to you as an investor. You don't know where you're going to be in 2-4 years' time. Your life situation may have changed. You might want to have the option of selling. A lot of investors do sell very quickly. And in fact, investors hold on to property less long than owner occupiers, which is an amazing fact. Yes, now in terms of the metrics that we use, so the primary thing that I've been working on is our market forecasting model, and that is the most scientific end of things. So that's the most about just purely back-tested, not my opinion in the slightest. It's just except to like check the veracity of the data. And that's very much looking at pricing, volume. So you think of it like technical trading in the stock market. It's very similar to an algorithm like that. So if you think of suburbs as like stocks is one way of thinking of it. So it's like, is there enough volume for us to be confident about where this market is, and how are other markets comparing to it? So one way of thinking of it is like in the stock market, you have pair trading, where it's like if one suburb goes off relative to another one, is it going to come back, or has it changed in some fundamental nature? Does it have different housing stock or a different kind of market? So yeah, the forecasting algorithm, very distinct thing that's purely synthetic, purely made by the AI. That is very much a function of prices of individual homes, how much they sell for, profitability of homes, nearby similar markets. It learns from a lot. And so that price thing is particularly powerful in that it works. If you get it right, then you can make money over time. So we've optimized the model to be always overall for on average profitable. So rather than having a situation where it works great for a while and then market conditions change. So I have background predicting these kind of things. It's more technical trading. So you can have a problem. You can have these ultra optimized technical trading algorithms that work well over the short term, and then you look at it and go, market dynamics have changed. We need to turn this off now, or there's a debate about whether to turn it off. Whereas this model is more like, okay, what are the fundamental things that have remained the same? What are the fundamental patterns that have remained the same since 1990?
Yeah, because in your model, like you've obviously dated back since 1990, and then your forecasting tool, you can look up to, is it 4 years in advance to give you that accuracy or the
That's right.
confidence?
That's right. Yes, we look 2-4 years in advance, and in our analytics in the back end as well, we are correlating this against longer term trends, like 8 years. The shorter term the opportunity, the more likely there is mispricing. So the models fundamentally are just looking for mispriced assets, mispriced suburbs. So it's like, this thing's price really should be this given everything else that's going on. So that mispricing decreases over time. So the longer you go out, the more it's going to retreat to a better priced model. There's more time for people to digest it, understand it. More buyers and sellers effectively cast their vote by agreeing to certain prices.
So where's your head at now with all these data metrics, right? Like Jared and I, we've been involved in trading stocks and short term and long term, and I used to do a bit of currency trading back in the day and realised I sucked at it, so I left. Is property in your mind, with all these extra data metrics, getting more so towards I guess a medium term tradable asset? Like, how do you sort of view your property investing mindset now with what you can see?
So I always look at the history. So what we can see is that there are lots of markets, there are lots of times where the average person in a market made lots of money even after 1 year. So that happens about 6% of the time. There is, I have it written down here. 6% of the time there is over 20% net growth. So net profit. So after considering CGT and real estate agent fees, stamp duty, So there is a proportion of the time. So if you look at the stats, you'll hear a lot of people in the property game say it's simply impossible to make money in the short term. Don't try. The reality is that you can do it. It's just the shorter term it is, the higher the risk because the more costs. So obviously your average property so this is looking at actual properties that are bought and sold. And so, and in that there is a bias towards people wanting to make money. So people are less likely to realize losses in the property game because you've got a whole lot of mums and dads that are loss averse. That's a whole other. Your average one definitely does lose money, but at the shorter the time period, the more opportunity there is to be flipping. So obviously you can buy 10 properties buy and sell 10 properties within 10 years and one property within 10 years as well. So there are more and more opportunities in the short term, but also because of the transaction costs, there's more risk involved. So what you need is a reliable system. So the more confident that you can be about the short term, the more you can rely on that. As I say, I would still want it to be performing over longer periods as well, because there's no guarantee. So our model outperforms the market. So taking the top 5 suburbs each month, it outperforms the market 85% of the time. Wow. The 15% of the time that it doesn't, it's almost always still a growth in the market, just not growth relative to the national average. So, there's always a level of risk, and anyone who tells you that they're absolutely guaranteed, I've seen people list I've seen a graph where people had all these dots of how much money each property made, and there wasn't a single one over a long period that lost. I think that's unrealistic. I wouldn't trust their methodology, or how maybe they're leaving out a few properties that they don't want to talk about. I don't know. There is always a risk. So you can mitigate that risk by ticking more boxes, having a shorter and medium term good potential.
Is there an average time frame? I mean, it's going to be dependent on the location and the property type, I guess. But is there a average sort of time frame where a property typically returns quite well and then it sort of like calms down a little bit, like the bell curve? Is there a
Yeah, so obviously your average market performs averagely. So I'm just looking at our big thing is we're always comparing to average growth. Yeah, so that's always my frame of reference. So it's like, yeah, there's going to be a certain amount of like growth in the property market because it has these solid fundamentals. We're all about outperforming. So that's my frame of reference. When I'm talking about growth, I'm talking about growth relative to the national average. So your average suburb performs averagely. Yeah, so you've got this distribution where if you met normal distributions like that, where most properties are just ticking along, following the national average, following their region, even more so. And then you have these outlier suburbs that are performing particularly bad or particularly good. And so those ones they'll typically will perform well for a while and then they will go into reverse. So there's a hell of a lot of mispricing in the real estate market because there's a large number of products to buy. If you think of suburbs as like products, and there's a small number of buyers, so it's very imperfectly priced. So just taking it from a technical trading point of view, particularly as you go out of the capital cities, the more remote you get, the more they are mispriced. So your question about timing, so one issue is that markets don't have nice time periods. I see all these stuff about, there's a 7-year cycle or a 20-year cycle. I don't see that in the data. So I see that markets have different lengths. They could be 5 years. They could be like a boom might be for 5 years or for 4 years or 2 years. It's quite variable. And so it's quite a sophisticated thing to work out how long it's going to go. But yes, broadly speaking, if there is an opportunity to buy in a particular suburb, it lasts for a period of time. So, and it declines. So over 1, 2, 3, 4 years, and by about 7 to 10 years, that just from that pricing point of view, it's likely that it's gone back to the average. So yeah, a pricing model that's trying to build, mispricing is a shorter term opportunity.
Does that lead into like your confidence levels, more established markets? Like you got the regionals, right? And then you got your sort of your metros. Would your, like with what you've seen in the data, is it pointing more towards solidarity in those metro markets, or are you still pretty confident around those few years of good growth in, say, even major regional towns? Call it like Bundaberg, Townsville, all that. What's your sort of thoughts around? Because I see a lot of people, Kingaroy as an example, or Gympie. Yeah, there's interesting sort of data metrics coming out of there, but then it's like, well, what's that medium term prospect? What's your thoughts around that, and what have you seen?
Yeah, so as you go for capital cities, the closer you are to the CBD, the more you have more the pricing is accurately reflected, and there's less opportunity for mispricing, but there is also more volatility. So if you're in the closer you are to the CBD, the more you have loads of amenity already, you have diverse employment, and it's more already sorted. So but basically what you could think of inner city suburbs as like blue chip stocks. So they're less likely to grow massively, but they're also more solid. Yeah, so it's a safer investment, and particularly as you leave metro areas, there's a drop off as you go outside the metropolitan area, and then so you're getting ever more potential for massive price movements given enough volume. So I think, and it comes down to distance and density as well, is one thing I've seen in the data. So you can have the Hills District in Sydney where it takes a long time to drive, and I suspect that buyers will just drive over a smaller area where it's lower density. So density, I think my suspicion is, as density of its own tends to drive. Low density means higher risk, high return, but then you've just got sparseness and remoteness. So as you're going really remote, mining towns massively underperform. Like just avoid mining towns. Absolutely, that's just like terrible.
101.
What's that?
Investing 101 or property investing 101.
Yeah, I've seen it in the data, so I'll repeat it because I've seen it. So I'm not repeating what others are saying. So that's one of the first things that comes out. But there are fantastic opportunities in small towns. So you can have a town that's just sitting along. It's got the same price for years on end. The overall region has gone up like that, and then there's a certain point where it snaps back. So it suddenly starts following the region. But timing that is a real issue because this can go on for years. And so as you get to smaller towns, that particularly if they don't have a real estate industry per se, so they don't have local sellers agents or buyers agents, property managers even. So then you're looking at there are absolutely massive returns to be had there in these much smaller markets. But yeah, it's a function of remoteness. So you mentioned a larger town is going to have where there's more diversity of employment and there's more amenity, then you're getting more to the safe stuff. But if you go for remote, like if you go to Dubbo and then you drive in a random direction 150 kilometers and find something that's totally not on the map, then you've got these massive opportunities, but also massive risk.
It's kind of like any sort of investing is like the higher the risk, the more you can make in a shorter period of time, but the risk is high as well. Exactly. Yeah, I would avoid. Is that one of your laws? Like you mentioned at the start of the podcast, like you like to go by not this suburb's popping off or the fad gimmicky thing that's hot in the press. You like to go off a few laws. Is that one of the laws? And what sort of other laws do you sort of like have you seen formed? Which I guess is probably a natural law because that's the same with anything in life, I believe, with investing your time, money, anything into something that's high risk, can be high return, but you still got the high risk. Are there other sort of laws that you've seen come through that have shone out of the data? Yeah, so one is obviously the laws of supply and demand. So I've done some analysis before on land supply. So if you have a lot of it, particularly within capital cities, it's a big problem. In the case of regional, it can be a plus because you're getting more amenity in there. So you can actually have a critical mass effect. So supply and demand is the fundamental of all of these laws, obviously. And then out of that, I guess there are sub-laws. I think this is a really good way of thinking about it. Maybe I should have this list of laws. But yeah, so the performance relative to, so there's within any market, you have mean reversion. So that is a fundamental law. That is that markets get overpriced or underpriced, and then they go back. So this is an answer to all of the trends. So I've seen all kinds of trends where it's like quiet streets are doing well, and then it flips back to being noisy streets. I think it was the other way around, actually. So it's like all these things, you look over a longer time period and it can go away. What you're left with after that, though, is very interesting. It's like, what are the things that continue to stay strong? And one thing I found is coastal areas. So 1.1% annualized growth better among the top decile of the country in terms of humidity and rain at a certain time. So it comes down to quite technical things there, but there is definitely a trend towards coastal areas, particularly at the mouth of rivers. There are some suburbs like Bateman's Bay, a few others that have had extreme, Thompson Beach in South Australia, Burnett Heads and Innes Park in Queensland, where you've seen very consistent, strong growth over the entire 34-year period, which is pretty amazing. So that's one I'm keeping an eye on. And then there's demographics, so and gentrification. So you definitely have suburbs that are doing it tough, that have vulnerable people, and the growth outlook there is not strong. It's certain kinds of vulnerable people, though. I'll be putting more research out there. It's not merely just
low income or something like that. And then you've got a sort of burgeoning entrepreneurial kind of market that's doing very well. That there are just certain metrics, certain ways that they record their financial information that you can see. It's not as obvious as just like looking at how nice are the houses. And then you've got at the top, you've got this more, upper middle class, where people are putting money into things other than property, and you've got a mature market. So there's there's gentrification, mean reversion. The flip side of mean reversion is momentum. So obviously things do go for a while, and so these are the length of markets. So that's a law that markets for a time do follow a trajectory, and then they go into reverse. And then there are these certain sort of long-term trends about desirability, picturesque places that I'm doing more research on. They seem to have really good long-term prospects.
You got me thinking a few different trends, and like especially the Perth market at the moment. Like I definitely feel like it gets to that sort of stage. Same in the stock market, right? You get the sort of the FOMO, the piling in, and then it's going like the mean. I imagine it's going above that, and my fear for a lot of people that are still piling in there is that there's a reversion back to that mean.
Absolutely, yeah. So it can be too exciting. Everyone's pumping it up. It has a good story behind it, So it's like, hey, it's cheaper than other capital cities, or hey, it's got all of this great mining, and the federal government's throwing lots of money into WA at the moment. There are good stories that go out there that make sense. It's positive cash flow is another one. Yeah. So you have these really powerful stories that the problem with these stories is they keep working after the price has moved. Yeah. So it's like you have all of these property pundits training up their sales team on a particular area. You don't want to keep retraining them. It takes time. It's expensive to do that. Yeah. You have a marketing campaign. It's running for a certain period of time, and all of that continues to work. The narrative stays the same, but people are piled in. So the word gets around in the small town, or the real estate sellers, the sellers agents are fully onto it and are drumming up excitement among their vendors to get higher prices. They're definitely taking advantage of the situation. So yeah, you can end up with this overpricing. So this overconfidence, this brimming little mini bubble that can then get burst. And there are actually people out there. I did see a pundit, so they're in the space. I won't even say exactly what their business model is, but they do say that, they buy properties for clients and they give them first access to them, and then they go out and sell them to the general public. And obviously that's kind of like pump and dump, right? So there's actually, I'm not saying they've done anything illegal. I haven't even named them, so who cares? But so you are getting into the territory of what would be definitely illegal in the stock market. And it can, as long as it sells, like, it's a sales oriented industry. So if it is resonating with people, if it's getting clicks, it's getting people signed up, it's getting people, and they can often say, look, they can then go back to their clients and say, look at the massive growth that I got you over a year on year period, and is kind of real. So they could actually sell if it's still continuing to be pumped. They could actually sell within that and do very well for their clients. And obviously the ability to create examples to say, hey, look, we bought this property and for this little house with the garage takes up most of the frontage, and we bought it for this tiny amount, and now it's worth all of this. So there are some definite systematic imperfections in the real estate game.
Yeah, it's wild. So the larger the, I guess, could be the business model of like buying properties for people. I think everybody knows what we're talking about here. If you can read between the lines, is those companies that acquire a lot of property for people can create markets and can create them and then have them die over time.
That's right. Another point is that if you're going to invest a whole lot of time in marketing, so let's say you're going to spend $50,000 retraining people and promoting this, you're going to need a market that has lots of supply. Yeah, you're going to need lots of places to buy, and so that raises the question: why is there so much supply on the market? Yes, you may even succeed in increasing the price if you exhaust the supply, but whereas if it was me, I'd much rather want an algorithm tell me about some unique place, and there's only a couple of properties to buy in this little town, and then you can do whatever. You don't have to worry about some short-term scheme that's a little bit too close to people's business models, if you ask me.
Yeah, this is I guess goes down to always be careful of free advice, and I mean the value of paid data and research, because I guess I got a lot of people come and they're like, oh, where's the best place to buy, and they do see there's massive marketing campaigns. Like, let's be honest, like people spend saying a jab before we jumped on, like, marketing is $1 billion industry to convince you to buy things that you either don't need. But in property, it's like, it could be that, and it's what you've mentioned is very common, where they go in, they buy in a certain market, and then they go and market it to the general public. And that's like, it's like, well,
it's making that job easier.
Yeah, it makes you look good. You do the 12 months review. Look how much money I've made you. Let's go again. Are they doing the 2-year, 3-year, 4-year, 5-year review and going, oh, well, we had that good kicker in 12 months? Of course they're not. Why would you do that? Like,
no, that's true. So yeah, that definitely happens. It can also happen even without any dodgy intent. So it can also be just a very a personality who has a lot of followers, just goes really strong on a particular area, and maybe they're not particularly buying it for their client, but the mere fact that it's popular means that a whole lot of people are going to pile in, and it's going to be too much. Another point is that in the industry, there's a lot of copying of one another. So it can be that a whole lot of others who are less ethical jump in on the same thing. It's like, yeah, that's a good story. We can try that one. This one, it's resonating. It's resonating with their customers. We can try and see if it resonates with ours as well.
That's a really, really good point, because obviously I do with clients every day, and we'll have these conversations around locations. And Perth, WA, it was a really easy story because people, investors that aren't like, I guess, seasoned investors, they're just looking for their first or second, maybe third investment property. They're looking for low maintenance, near a CBD, near water. Because of like that scarcity factor. That's why WA was always a really easy sell, and the cash flow as well was there. Then you go up to places like Townsville. Obviously there's some really strong fundamentals there, but similar types of houses, more, I guess, modern. That perception of people, of investors, they think, I'm going to buy an investment property, I want 4-bed, 2-bath, double lock up, modern-ish type of home, and then I want it near the coastline because I just have security to coastlines. That's what I've seen in that sort of psyche of the buyer. And it's like, well, that's been conditioned over, years and years of marketing material, because even now people are still running around hunting for positive cash flow, but wanting metro exposure. And that positive cash flow story, sure, it was possible when interest rates were 2%, but it's a different dynamic now that I'm seeing.
Yeah, so I'm definitely going to research more about the coast. So this is something that's come up in the data, but I haven't gone direct on it. But it's looking very positive for me over the long term from what I've seen. But the devil's always in the detail. It may be certain ones. So is it particularly when you're at the mouth of a river, or if you have fertile soils or something? The relationship of capital growth to yield is an interesting one. So it is, in general, it is actually positively correlated. So in general, more yield means more subsequent capital growth, except at the extremes. So if you go to the top, I think it was the top 5% of yields, then capital growth is very poor. So that really is your segment. So the graph, if you imagine there is yield on the x-axis, we're getting a bit technical here, but capital growth on the y-axis, the graph looks like this. So it's like a back to front end. And so once you get to that top 5% of yield, then capital growth is really poor. But short of that, it's actually a really good thing to have yield. So it's not like an inverse. I would have guessed it would have been an inverse correlation, because it's like, oh yeah, you've got a trade-off between capital growth and yield. Some people are going to want more income, sort of like, in stocks, do you want dividends or do you want the capital growth? Do you want the Aussie stocks giving you the dividends or the NASDAQ ones giving you massive capital growth? Yeah, but that doesn't play out in the data. So it's really at the extremes. So if you're going for pretty good, like really good yield, but not the best yield, then I think you're in a much better place.
There's that sweet spot is kind of what I'm picking up.
That's the word, sweet spot.
Is it, there's a good surfboard called the Sweet Spot, in case you're wanting to get involved in that, mate.
Sounds like a fun ride.
Yeah. Well, is like with that sort of, you go to Sydney, right? And then you have the median house price is a lot higher. Is it a case of also affordability where, you get over that sort of $800,000 and then your yield drops away because it doesn't keep up with that capital value? Is that kind of in the data, or is it like with matching of growth as well? Like, I guess my point being is the sweet spot of the yield between like sort of like what 3 and 6%.
The sweet spot is high. So I was looking at it as a ranking in my case. So it was like for whatever the yield is for the country at the time, because usually I'm looking back a long period of time. So I'm very much my focus is very much compare markets at the current time. So given those market conditions, and so that way I can do more your like for like, what was going on in 1993. So that's been really my focus. I'm less on because interest rates are high now and lots of different factors. I try not to get too deeply into that stuff because I can't prove it over the longer term. But yeah, I mean, there's a whole lot of economic stuff here that makes sense. And yeah, I mean, broadly speaking, obviously your major metros are safer. The standard deviation of growth keeps growing as you go further away. I guess that's what I have to say about that.
That makes
I don't always have all the answers. You should hope that your expert doesn't have all the answers.
No. Well, I guess there's the other thing too is we're always constantly learning, no matter what we do. My other interest, like obviously the long term or the 1990s, right? Like people are, the economic environment, business environment at the moment, the conversation of, we've seen since the lockdowns some incredible growth over the last 4 years. Are we peaking? Are we going into, that sort of, what do they call it? The winner's curse phase of the cycle where people are overconfident, they're just piling in FOMO. And then it goes, the GFC comments come up, like, are we heading into something like that? With the data, like going back to 1990, you've seen multiple, peaks and troughs. You mentioned one of those coastal suburbs, they've been consistently performing. Is there a strong case for you can make money or assets can go up in any market if you are looking at the right data metrics?
Yeah, so the data shows that in every single time period, there have been markets that have grown. So there's always growing markets within the Australian economy. Obviously, sometimes it's most markets, and in general, most markets grow, and a small number don't. So there always are opportunities there. I don't take So the problem with macroeconomics is economists are well known not to be able to be great at predicting the future. So it is quite a tough game. So, I mean, but I do like to listen to it, and I find it often interesting and logical, but I'm always like, okay, given the 35 years that I have data for, what can I prove? So if there's an event that happens once, like COVID or the GFC, or recession back in 1991, then it's like, yeah, I don't have enough data to speak confidently about something that happened once. So I'm much more about like, okay, I just want a model that makes money regardless. So that might mean that I pare down the number of metrics that I look at. So it's like, given that there are going to be black swans, we don't know what the next one's going to be. Is it going to be, a big nuclear bomb or big change in government policy? And we've worked out how to everyone to be happy about there being another million immigrants in the country every year. I don't know what the next black swan is going to be. I just want to have a model that is resilient to black swans. That's my goal. Can't be perfect with such a thing because, a meteorite hitting the Earth would be quite hard to model for. The big one, anyway. So there's all this. I'm not a macroeconomist, and I can't tell you. So I don't have in my models what's going to happen to the Chinese shadow debt market, or I follow a little bit what happens in Ukraine, but I can't say that I'm an expert. So there are lots of modelers out there who have spreadsheets, and they have some yellow cells, and they're like muck with a few things. They have a model, and then no, that sounds too low. No one would accept that. Change this input, change that input to that. I never model with spreadsheets, so it can be done, but as you're getting to more complex things, it's harder to account for them. So it's like in AI, you can feed it a very, very large amount of information, but it's like, in my view, I'm particularly interested in any info that can reliably predict the future. So it's like, I want something that worked in 93 in South Australia and works in 97 in Queensland. It doesn't matter where, I just want it to work consistently. So I leave a lot of these sort of economic conversations, like, how is Albanese going to react? Are we going to have lots of stimulus because people losing their jobs to AI, or will one nation get the balance of power and then we get much fewer immigrants? It's like, I don't know. I don't know if anyone knows. So I'll just focus on stuff that I can prove.
Awesome, guys. Thank you for listening. I'm just going to cut this clip here because this is the beast of episode and we have so much more that we're going to get to. Thanks for listening in. Again, if you haven't got our How to Maximize Your Borrowing Capacity course, head to propertypals.au/resources. You can get that. And in part 2, what we're going to be talking about, Sam, is 2 different things, right? We're going to talk about the future of Australian property, the landscape of it, and then what was the one that you really loved?
Yeah, obviously in the world that we've evolved into, technology has definitely come a long way, and we discuss artificial intelligence. It's a key buzzword on everyone's lips, but there's a lot of data points that Lou's collected that's basically integrating artificial intelligence to help you understand where property prices and growth's going throughout Australia. So really, really interesting chat. So looking forward to you to join us on part 2.